Yeah, good day. This video on new changes in the personal income tax for 2023 is powered by Accurate Consults. And the key focus of the video, the short video, is on the changes in federal tax laws for 2023 that relates to personal income tax and the provincial personal tax changes. As Ella said, this is powered by Accurate Consults. That Accurate Consults will provide tax and accounting services to small businesses, where small businesses to prepare their corporate income tax, help individuals to file their personal income tax. Also, we help with GST and HST filing. We help small businesses to incorporate their businesses. We also help them to facilitate payroll service. So if you need to pay your employees, set up on automated system that does remittance to CRA, a debit your account, and does your required remittance CBP you can engage us. We also help small businesses in terms of business consulting and advisory, and also in terms of preparation of financial statements for small businesses. You can contact us through our website or send us an email or give it a chat or a phone call. So these are the key changes to federal personal tax in 2023. The first one is residential property flipping rule. So because of the shortage of rental homes units in Canada, and because of the activities of flippers, speculators driving the price of real estate in Canada, the government is implementing this rule to check the activity. So what the government is saying is that any property that is being sold less than 365 days after purchase will be charged 100% tax in terms of the net profit from that business will be charged at 100%. Before now, if you sell your property less than 365 days or more than 365, this might not apply. So government is saying if you sell your property in less than 365 days, then most likely you are a flipper. Even if that's your only property or your principal residence and you sell it before less than 365 days, this will also attract the maximum tax rate. Even though it's an assigned, this also applies to assigned property. So if you have an assigned property that has not been closed and you sell it before the purchase date, this law will also apply to it. Now, it does not apply if the eligible relocation of the taxpayer to carry out businesses. So for example, if I live in Ontario and I get a new job in Alberta, I can sell my property in Ontario and move to Alberta. This law will not apply to me I can sell it in less than 365 days and it will not apply to me. So these are eligible relocation if maybe for business purpose, for employment purpose, or for full-time post-secondary school education purpose, then this law will not apply to you. Now, if you sell in less than 365 days, your profit on the sale is 100% taxable and it will be treated as a business income compared to it being treated as 50% capital gain if it's a principal residence or not. Now, what they are even saying is that before now, if you sell your property, it will be treated as 50% capital gain. It means that you only be taxed on 50% on the net profits. But now, if you sell less than 365 days, 100% will be taxable. So this is just to check to discourage flipping by speculators. Even if you make a loss on the property, you can't use the loss to reduce your taxable income. And this is effective January 1st, 2023. So for all those that sold their properties in 2023 and they purchased less than 365 days, this will apply to you, even if it's your principal residence. This might not be fair. Some people might say it's not fair because the law was introduced in the middle of the year, but is backdated to 1st of January 2023. The second changes that relates to federal changes is multi-generational home renovation tax credits. Now, government, because of the shortage of rental homes units in Canada, government is trying to encourage individuals to renovate their property so that their parents, their grandparents, or their relatives that are enrolled for disability tax credit or eligible for disability tax credit can stay with them. So what they're saying is that you can get a tax credit, a renovation tax credit, if you renovate your house or reconstruct it so that a senior, that's your parents, or maybe anyone that's related to you that is enrolled for disability tax credits. Now, the renovation must be a secondary unit that is the self-contained, that has a private entrance, a private kitchen, a private bedroom, and must meet local requirements. If it does not have a private entrance, let's assume you have a 3-bedroom and the 3 bedrooms are in the second or upper level, and you renovate it and say your parents should stay in the maybe one of the rooms, that does not qualify. It must have a private entrance. Most likely, if you renovate or reconstruct your unfinished basement, that has a private entrance, a private kitchen, a private bedroom, and meets local requirements, then you can enjoy this tax credit, maximum of 50K, and at 15%, you can reduce your taxable income or your tax payable by $7,500 at this 50K renovation expenditure. And who is a qualifying individual? The person must be related to of course, must be related to your parents, your grandparents, or the person enrolled in this disability tax credit for you to be able to claim this. And also, the qualifying individual must be a resident of Canada throughout the tax year. So what they're saying is that from January 1st to December 31st, you must reside in Canada for you to be an eligible individual renovating your property to accommodate your parents, your grandparents, or anyone related to you that is enrolled for disability tax credits. Now, the third further changes is the first home savings account. So the government is just trying to separate the usage of RSP, registered retirement service plan, for down payment. So before now, people put money in their RSP, and if they need to buy their first home, they can withdraw from RSP to purchase their first home. Now, this first home savings account is a mix of RSP and TFSA. RSP is the registered retirement service plan, and any contributions is tax deductible. You can use your contributions to reduce your taxable income. For TFSA, is a tax-free savings account where any savings you have in that account, max of maybe 40K, is not, so the interest on the savings accounts is not taxed. It's not taxed. It means the tax-free savings account. So this first home savings account is a mix of the two and can allow you to transfer from you can transfer from your first savings account to your RSP after using it, and you can withdraw for it for your first home. Maximum savings of 8K per year, lifetime maximum savings of 40K, and you can use it to reduce the contributions, the savings in your first home savings account can be used to reduce your taxable income by the amount you contributed in a given tax year. Moving on to the next tax changes, federal tax changes. This started in 2022. Now, during COVID-19 pandemic period, some people got benefit from government. After a year or some months after, then government realized that those people are not eligible for those benefits, and government mandates people to pay back. And government is saying that if you repay any of these benefits, you can use this repayment to reduce your taxable income. So you can claim it as a deduction to reduce your taxable income on other reduced taxable income by the amount you repaid. So for example, if you repay $500 in 2023, you can use that $500 to reduce your taxable income. Temporary flat rate method for work from home office expenses. During COVID-19 pandemic, just to encourage people to stay back at home, government introduced the work from home expenses. Now, government is saying, because they're trying to encourage people to go back to the office, before now, in 2022, there are two ways of claiming work from home expenses. You can use temporary method of the detailed method. For the temporary method, you don't need to get any letter completed by your employer. Why? For the detailed method, you need a letter from the employer. So government is saying, going forward, you won't be able to claim the temporary flat rate method. You can only claim the detailed method. So for you to claim the detailed method, you need a letter from a form, this form to be completed by employer and signed by employer before you can claim the detailed work from home expenses. Government just trying to discourage work from home just to stimulate the economy, persuade people to go back to work. Businesses around those offices can experience increased activity to increase GDP. Also, there are changes to the federal tax bracket for 2023, just like you have changes for most of the provincial tax bracket. So that has been increased by 4.7%. Now, from your taxable income, taxable income is what the federal tax rate is applied on. The taxable income is derived from your total income minus deductions to get your net income minus other deductions to get your taxable income. Your taxable income is a major line in your personal income tax. So for you to maximize your personal income tax benefits, you need to reduce the taxable income to the barest minimum. And so what he's saying is that if your taxable income is 53,359 or less, you'll be charged at 15%. You'll be charged at 15%. Now, if your taxable income is between this amount and this amount, the first 53,359 will be charged at 15%. The balance will be charged at 20.5%. Now, if your taxable income is between this and this amount, the first 53,359 will be charged at 15%. The next 53,359 amount will be charged at 20.5%, then the remaining balance will be charged at 26%. If your taxable income is between this and this, the first has 15%, the balance between this and this amount will be charged at 20.5%. The balance between this and this amount will be charged at 26%, and the remaining will be charged at 29%. And if your taxable income is more than this, the last range, the first will be charged at between this, will be charged at 15%. The balance between this and this will be charged at 20.5%. Balance between this amount and this amount will be charged at 26%. The balance between this amount and this amount will be charged at 29%, while the remaining will be charged at 33%. The higher your taxable income, the higher will be your tax brackets. Now, short-term rental deductions. Now, this rule will be applicable in 2024, but just to let us know that government is trying to discourage short-term rentals because they realize that there are a lot of vacancy, a lot of accommodation not being occupied. People are using them for Airbnb and short-term rentals, and we're saying that we don't have a lot of home unit for people to rent, for people to live in. So government is trying to discourage short-term rentals by implementing this law. Now, in cities like Toronto and Vancouver, this law is applicable. So you might need to reach out to your municipal to confirm if this law is applicable in your city. Now, what they're saying is that instead of deducting expenses, so let's assume in a year on my Airbnb, I earned a rental income of 100K. Now, government is saying you won't be able to deduct the interest on your mortgage, all the expenses incurred in running the Airbnb. If you pay a cleaner to help you clean up, you get an agency to help you manage it, all the relevant expenses, your gas, to manage the site, if you have a website, you won't be able to claim any expense to reduce the rental income. So the gross income from the business will be taxed. That's what the government is saying. Before now, you can use expenses to reduce your taxable income, like interest on mortgage, management fee paid to administrator to manage the property, cleaners to manage the properties, and other expenses associated with running the Airbnb. Government is saying if you live in these cities, in applicable cities, you're able to claim expenses to reduce the tax on the rental income. Now we move to the significant changes in provincial personal tax laws for 2023. The first one is staycation tax credit. The Ontario government introduced this in 2022 to drive tourism in the province. People can come to the province for tourists, for vacation, and the rest, and they can claim hotel bills to reduce their tax. They can get tax credit to reduce their taxable income. Government had discontinued this in 2023. In Alberta, they increased the charitable donations for small donors. Now, small donors are donations in a tax year that is $200 or below. Before now, the tax rate you get, like the credit you get on anything $200 or below is 10%. Now, the Alberta government has increased this to 60% just to encourage small donors, people that donate, the middle low-income people that donate around this amount yearly. Of course, 21% still apply for any donations that is more than $200 in Alberta. So this is how it works. The first $200 will be at 60%, and the remaining amount, so let's assume I donated 1,200 in a year. The first 200 will be at 60%. The remaining 1,200 minus 200, which is $1,000, will be at 21%. Also, the renter's tax credits. This is recently introduced by BC, British Columbia. Residents can claim this refundable tax credit if you meet all the following conditions. you rented and occupied a rental unit for at least 6 months in Alberta in 2023, you are 19 years of age or older, you are a resident of Alberta as at the end of the year. Yeah. Before now, I know the Ontario government also had this in place, a rental tax credit just to compensate or support renters that are earning low. Now, of course, one of the conditions, most of the conditions for most of those provinces that have renters tax credit, the family income must be low, maybe less than 50K before you can benefit. Even though you apply for it, if the family income is more than the threshold, you're able to benefit. Thank you so much for watching. You can subscribe to our YouTube channel, contact us through our website or email or phone call if you need any of these services. See you in the next video. Thank you.